Well, I like them because they allow me to continually drip feed funds in, and I know that they're just going to be following what the markets are doing. It means that I don't necessarily have to keep an eye on it every single day.
Well, I'm not really very keen on them because, it's the sort of the herd mentality is what I feel, so they're always going to be sort of tracking, so as it's going down, it's going to be going down and sort of tracking the whole time. So no, I've never been very keen on them.
From what I know, they are very low cost and low commission rates and easy to use, especially online.
Hello and welcome to Stocktalk, Selftrade's regular programme discussing investments, markets and financial planning. This edition takes a closer look at exchange-traded funds, ETFs, and asks what are they, what makes them special, and how can they be used in a balanced portfolio. ETFs are passively managed instruments which track a range of market indices and sectors from Britain to Europe, North America, Brazil, Russia, India and China. They combine the characteristics of a quoted instrument, like a share, with a more traditional fund, a hybrid if you like between an OIC and an investment trust. Launched in the UK back in 2000, there has been an explosion in issues and issuers since 2006, when regulatory and taxation changes made London a more attractive home for the product. There's plenty you'll need to know if you're thinking about investing in and getting the most out of ETFs, and this programme is designed to help you do just that. Over the next few minutes, we'll be talking to Dan Draper of Lyxor and giving you our ETF insight. But first, here's our quick introduction to exchange-traded funds. ETFs are index tracking funds offering access to markets across the world. But what makes them so innovative and how can you invest? So what is an ETF? Well, unit trusts and OICs, with which most people are familiar, are what's called open-ended. This means that new units are created when investors buy and they're cancelled when they sell. The instrument trades at net asset value of the fund. That's the sum of its parts divided by the number of units, and they're usually priced just once a day. Equities, such as investment trusts or shares, are different. Closed-ended, they are quoted on the stock exchange throughout the day and have a fixed number of shares in issue. The price is therefore determined by supply and demand. Now, imagine a mix of these, an open-ended fund trading at net asset value, which is quoted on the stock exchange. Well, then you have an exchange-traded fund. Throw into the mix low charges, transparency and excellent liquidity, meaning you can sell whenever the market's open, and it's little wonder that ETFs have established themselves as a staple portfolio component. Most ETFs are index trackers, and the range of underlyings is what makes them especially attractive. The FTSE 100 tracker might be the most popular, but it's only the beginning of an ever-growing selection. The choice of ETFs includes indices such as the UK, Europe, Asia, USA, Russia and South America. It means property, water, infrastructure, private equity, bonds, commodities such as metals, agriculture, livestock, energy, and these new fundamental ETFs. So, how do you invest in an ETF? Well, it's simple. Since they are quoted on the London Stock Exchange, they're as easy to buy as shares, and cheaper too, since like funds, they don't attract stamp duty. Prices are available throughout the day, changing with the net asset value of the fund. ETFs are highly flexible instruments which can be held in a range of accounts, including dealing, ISA, SIP, and even self-select child trust funds. So, ETFs are cost-effective, transparent, and liquid index trackers. For the real detail on the product, we spoke to Dan Draper of Lyxor. I started by asking him why ETFs have such a comparatively low profile when compared to traditional funds.
ETFs are new. That's really the main reason. New innovation, the concept idea, the theory, if you will, it really started back in the 1950s when people started thinking about investments in terms of portfolios and diversification. But that really led through the technology innovations, lower trading costs in particular through the 70s, 80s, and 90s, and really ETFs started really getting profile in the press and among the public in the last 5 to 6 years.
Are they complex? How would you describe these products in a very straightforward way?
Now, I think the simplicity of an ETF really does derive from what you're trying to accomplish, kind of the end goal. And that idea, again, comes from the basic idea that if you asset allocate if you allocate your assets the correct way, in the most efficient way, that gives you the highest chance of succeeding your wealth goals. And so from that perspective, working backwards, then you think, well, what's the cheapest way for me to do this? And that's why ETFs are simple. It gives you a top-down ability to pick the right asset classes in the right amounts for your particular wealth goals.
Are they for trading or for long-term savings?
Really both. Because if you look at what an ETF is, It's really a marriage of an open-ended investment company, an OIC, with a basket of shares. And as I mentioned earlier, it's that ability to, the trading cost, the technologies of trading large basket of shares, i.e. in a particular index, the FTSE 100, the S&P 500, what have you. It's that ability to trade them instantaneously, all at once, but then putting them into an open-ended fund that makes them, you know, the simplistic instruments they are, but also giving an investor the ability to buy as little as just one share. So it's taking things that institutions 20 years ago would have to do in large sizes, millions of pounds. Now we have it in a format where you could